Welcome back. The World Bank is proposing additional reforms to property taxes, particularly those in cities such as Nairobi. In the recently released Public Finance Review report, the institution argues that such reform, coupled with urban infrastructure planning and investment, as well as public sector savings, would contribute to a higher factor of productivity. According to the World Bank, Nairobi forgoes an estimated 5 billion shillings annually in revenue from property taxes. As Jimmy Mbogo now explains, the World Bank believes that these reforms will result in higher rates and rent and improving the allocative efficiency of land.
The recommendation by the World Bank to reform property taxes in the city is aimed at increasing city revenue from property rates, a source that the institution believes has the potential to gradually help pay down the county's pending bills and resolve liquidity pressures, as well as stimulate investment. At the time of the compilation of the report, Nairobi's pending bills stood at a total of 118.4 billion shillings in the 2023-2024 financial year, which is equivalent to nearly 4 times Nairobi City County's budget, accounting for 65% of Kenya County-level pending bills for that fiscal year. But according to Chachi Logutu, an economist from IC Group, such reforms are likely to face significant pushback from property owners and hold the potential to further increase property costs in the county.
And all this is within touching the wealthy to be able to pay their fair share of taxes. So I think that is what is coming out clearly, the wealth tax as a way of reducing the vulnerabilities that we're seeing, because even the report cited, even at a lower level of income, they are shouldering the largest tax burden. So that is what is at play here, even with the proposed introduction of these property taxes, which is just basically targeting the wealthy to be able to pay more. I think it might also have some natural pushback.
The World Bank is also expressing concerns over the high income inequalities, noting that those in the diplomatic corps in the country who largely earn international salaries, including Kenyans working in international organizations, are earning more than 4 times the average private sector salary in the country. This, the bank says, is a risk that can put pressure on non-tradable prices, such as the cost of rent, schools, transport, and risk eroding real wages for Kenyans earning in local currency.
So with those niche products, obviously it prices out a significant number of Kenyans out of that. So it may not be an issue to them. It could have been a problem if some of the social benefits that largely accrue to the Kenyan citizen is now given at a preferable rate to the countries. But that is not the case from what we're looking at. So it's like it's a buying willing seller, willing buyer kind of mechanism, and all these payments are at an arm's length transaction.
The government has also been urged to reduce its footprint in the economy by privatizing state-owned enterprises that create significant market distortion. According to the Bretton Woods institution, privatization can yield a one-off revenue gain that can help pay down public debt, with the bank estimating a potential privatization revenue of up to 154.9 billion shillings, an equivalent of $1.2 billion.
We still don't have clarity on the pipeline of what the privatization, what will be the actual privatization, or what is to be privatized, either by direct sales or via IPOs or whichever other format that the government is looking at.
Jimmy Mbogo, Citizen TV, Nairobi.